And so I think a lot of entrepreneurial success and true entrepreneurialism is being eyes wide open about reality, about imagining a future that doesn't exist, but also being realistic about today. And so we spent a lot of time on basically editing one another's writing until we got to a place where we said, okay, if we go and start this company together, it will be on a very solid foundation. And 4 years later, that's still looking pretty good.
Most founders look for easy entry points and fast validation. Ben Borodach did the opposite. He picked one of the hardest, most tightly regulated markets in America, tax preparation. He and his co-founder ran hundreds of customer conversations and treated the early years like a set of science experiments rather than a race for revenue. In this conversation, Ben breaks down what it takes to build a compound startup, how to sequence engineering, compliance, and distribution, de-risking unknowns in the right order, and how to maintain clarity, resilience, and judgment when you're operating inside complexity that most founders run from. I'm Walter Thompson. This is Fund, Build, Scale. Ben, thanks very much for joining me today. I really appreciate it.
It's great to be here, Walter. Thanks for having me.
You founded April in 2021 with your co-founder, Daniel Marcus. How did the two of you connect?
It's a great question. Well, first of all, here at April, what we do is we embed tax inside every financial decision. And the way that we do that is by building the most connected tax software in the world. Before I started the company, I was at a venture capital group called Team 8. It was started by some of the leadership in the intelligence community out of Israel. And the nexus was really that to solve really difficult problems in cybersecurity, you needed to bring together huge companies like Microsoft and Walmart that actually have the infrastructure and the scale. You have to bring together talent and capital. And so that's something I had built up, a cryptocurrency infrastructure company. I incubated it. We sold that and it became PayPal Crypto. Did another one around cyber risk that got bought by Moody's and BitSight. That is now the way that they get assessed as part of the credit score. And I was kind of working on what's next and wanted to go back to my roots within financial services. That's how I started my career at Deloitte Consulting, where I used to lead a lot of their fintech innovation work. And I really wanted to build or have an R&D component of my company based out of Tel Aviv in Israel. I think it's some of the best concentrated engineering talent in the world. It's probably the reason that Microsoft and NVIDIA and Google and many others have set up shop there. And so through Team 8, where I was working and incubating the company, I got connected actually by another founder to Daniel, who was at the time CTO of Waze and the CTO of Google Israel, and pioneering a lot of their data science and AI work. And so I think a lot of the problems that we deal with in tax and financial services are actually data issues. And so while he didn't know that much about US tax law, I was able to kind of sell him on this being an interesting data and AI problem. Mm-hmm. And that's how we got started together about 4 years ago.
I'm curious, why taxes? It's one of the hardest, most regulated spaces you could have picked.
Yeah, as an entrepreneur, I was looking for what were the things that excite me, that would make me want to get up in the morning and build. And the first thing is I want to work on problems that really affect all of us. And so tax is obviously something that affects 170 million US households, 30 million small businesses. It's the engine, it's a socioeconomic engine behind our society. And so for me, that's a fascinating problem. Nothing wrong with selling widgets or building SaaS software, but that wasn't kind of my calling. I get excited and get up in the morning to go solve a problem that helps people with their everyday lives. So that's part one. Part two is I had spent a lot of time in crypto and cyber and fintech, and I wanted to work on taking sort of a new approach to a traditional market rather than maybe like crypto sort of building into a new market, if you will. And so for me, I was sort of intrigued by markets that had a lot of complexity and it maybe hadn't been questioned or inspected in a long time. And if you look at tax, there's about 4 companies that process something like 80% of all US tax returns. Most of that software was built in the 80s and 90s. So, when we looked at, every time we discussed this topic of tax, we would hear like, oh, don't touch that. It's too hard. Don't go there. And I was like, well, that as an entrepreneur, I'm like, well, there's opportunity in that. Let's poke at that a little bit and understand why that's been the case. And that really brings me to the last point is I wanted to work around a paradigm shift. And I think we were early to AI. Mm-hmm. A lot of the reasons that there hasn't been innovation within taxes is because building this notion of a tax engine where you can get blessed by the IRS and all the states with your own tax engine, you can actually calculate and transmit tax returns. That's something that only about 10 companies have ever done. And as mentioned, most of them were built decades ago. And so basically, when we started, people said, look, Ben, Daniel, great ideas, but just don't even bother. I mean, you're just not going to be able to get off the starting line. And so our whole approach was, how do we not have 500 people offshore doing this and maybe doing it over 5 to 7 years? But can we use AI and data science to actually compress the time into maybe 2 to 3 years and do it with more like 10 to 20 people? And so that's what we've been able to achieve here.
What was the founder market fit moment when you realized that you were like the right team for this problem?
I think it was a series of looking at different parameters about ourselves. I'd spent a lot of time in and around financial services, so I have a broad set of understanding around the banking, wealth management, payments, and different elements. I spent my career in the B2B space, really understanding business workflow problems and solving those with software. And I knew that I needed a really strong technologist who was going to be able to sort of help me prove wrong, the naysayers that said this wasn't possible. And I think Daniel, having spent a lot of time in Google, particularly focused on AI and data science, Waze is one of the largest sort of real-time applications of data science and AI probably in the world, and rerouting millions of cars basically in real time. And so what we started looking at is how did that problem set intersect? Most of the tax law is congressional law, right? And what we have to do is basically translate it into computer code such that when Americans are collecting their data, we're able to actually give them a real-time response about their taxes and send it to the IRS. And as it turns out, if you do a bunch of manipulations and calculations, you can compress or accelerate the time rather by about 20x. So that's what we were able to do, is basically get a 20x leverage on human-only code and coding, and that's how we were able to be the first nationally chartered tax engine in about 20 years. So that's, I'd say, more on the professional side. I'd say on the personal side, we actually spent a lot of time both at large and small organizations, and I think had a very particular point of view on the type of company that we wanted to build and how we wanted to build it. And so we spent a lot of time actually writing our own, you can call it pseudo manifesto, if you like, about culturally what were the things that we believed? How are we going to resolve conflict? How are we going to reward our best people? How are we going to handle things when they did not go well? Because we spoke a little bit about like what does it take to be a founder, and how is it something that can become maybe more accessible to different kinds of people? And as a founder, ironically, when things are going well, you spend most of your time dealing with the things that aren't. And so I think having a clear and cohesive framework for that is critical, both to success but also longevity in this game. And when I was at the venture fund, most of what I saw were companies, when they didn't work out, a lot of times they just faltered on conflict resolution, right? There was a key hire that wasn't going well, and they just couldn't move on from the person. They were in denial about maybe the size of their market or about their competition. And so I think a lot of entrepreneurial success and true entrepreneurialism is being eyes wide open about reality, about imagining a future that doesn't exist, but also being realistic about today. And so we spent a lot of time on basically editing one another's writing until we got to a place where we said, okay, if we go and start this company together, it will be on a very solid foundation. And 4 years later, that's still looking pretty good.
You've described April as kind of a compound startup. What does that mean to you? And how is it different from a traditional startup approach?
Yeah, so I think the one way of building startups, which became very popular in the 2010s, is you would focus on solving one very specific lean problem, and you would take that product to market and try to scale it as rapidly as you could, right? And whether you look at an Uber, which was still doing something pretty complex, or a lot of the social media apps, right? They would try to focus on one very narrow target audience and try to get rapid scale very quickly. I think that's still a valid way to build companies, and we see, even ChatGPT, probably broke many rules, but inevitably had kind of one killer app that they went to market with. I think when you're in the world of B2B, and I think Rippling and Parker Conrad were some of the folks that popularized this, it's a little bit different, because the problems that your audiences are dealing with are naturally complex, because if they weren't, they wouldn't be talking to you in the first place. And because we now have, 30, 40, and 50 years of software out there, a lot of the problems that we're solving are not necessarily the first of. And so the problems we actually have are network problems. It's problems where we now have one piece of software over here, a manual process over there, or we're doing something one way over here and something another way over there, and we have to, streamline these or bring them together. And so naturally, the previous process I just described of building one narrow feature for one very specific ICP doesn't really allow you to get at those problems. It's kind of the wrong tool for that problem set. And so when we saw at April, our whole take on the market is basically there's two ways to do your taxes today. Either you can hire an accountant or you can go to TurboTax.com or an H&R Block retail store. We said there's got to be a third way. And the third way is you do it through your primary financial relationship, right? Because taxes they don't really make sense out of context. It's like, why would I take all of my documents that I've been working on all year and take them and bring them somewhere else where I get zero value? It makes a lot more sense if I'm already managing my money or I'm being paid or I'm storing my money and paying my bills to do that exercise inside of that. But the problem is to solve that problem, both for the individual and for the financial platform to actually get the value out of it. There's many things we had to do. We had to build API layers. We had to build user interfaces. We had to build a very flexible and extensible engine. And what we did in the process of doing that was actually find ourselves building a platform where suddenly we were able to configure, one part of our application one way for client A, and client B needed it done differently because their user base was a little bit different, or because the value that they were trying to generate was a little bit different. And so we found ourselves very quickly in a platform business, which is very comfortable to me because that's the world that I grew up in. But it took a lot more time to be able to build a platform that was robust enough and scalable enough where you could really do that, because we are in some of the most sensitive financial institutions in the country, touching many millions of transactions and data and PII. And so to be able to do that at scale, where you could both have the software capabilities, but also the trust and reliability that's required to be in our business was not trivial. But for us, what that means now is we have, some of the largest financial institutions in the country coming to us with their use case. And rather than having to build sort of an application from scratch, we are able to basically take our platform and maybe with a slight tweak, meet them where they need to in a quarter or less, maybe even days or hours. And so that to me is what being a compound startup is. We're now able, because of the investment we made over years in a platform, we're able to solve really complex problems and stitch together multiple capabilities that we have in hours, days, and weeks, not months, quarters, and years. And that unlocks tremendous value.
It also sounds like this compound startup model kind of creates a defensible moat in and of itself.
Oh, absolutely. Because and for us, what that means is we have a tax engine that's robust, that's real time, that's personalized, that's API first. We're the only company in the market that has that. But we're able to use that in many different ways. And so to compete with us, you would first have to just build
an embedded
what we
product.
have.
Yeah.
You'd have to build that. It would take tens of millions of dollars, years of regulatory capture. That's not trivial to do. Only then can you compete with us. So I think, yeah, for us, it's also about the moat, but building our curve. And it's funny. I've had discussions with this. I think the founder of General Catalyst, was out there saying, if you don't go from 0 to 15 or 15 to 100 in 2 years, you're dead to me. And I think it was sort of a provocative statement, so I don't mind it on its face. I think most of us in financial services are saying, okay, obviously we respect you a lot. You're, a person in the industry, but that's not really realistic if you want to solve really difficult problems. You can't build a cancer drug in that time period. You can't do some things require more gestation. Period. Even ChatGPT, they were building for 5 to 7 years before they even released their first product. And so I think, there may be certain moments or certain companies that can get out there and just get to rapid scale by taking advantage of somebody else's infrastructure that already exists. But as an infrastructure provider, to us, a lot of it is about the durability and the moat that we have in the marketplace that we expect will compound for many years.
And also these layers of complexity, you have to solve for the technology, the regulatory aspect, distributing the whole thing. What's the sequencing challenge there? How do you decide which layers to build first and which ones can wait until later?
Yeah, it's a good question. So we had a couple of different complexities that we had to sequence in the early years. The first one is that, the notion of this tax engine is kind of infinite because you have the IRS and you have the states, you have individuals, and you have many different types of businesses. So we as individuals talk about the 1040. There's also the 1120, the 1065 that govern different types of businesses. So we actually started with the leanest atomic unit, which was kind of like a W-2, just a federal return, like basically the smallest thing that you could build. And then we've scaled our geographic coverage and we've scaled our use case coverage. And we've done that now over 4 and 5 years. And now, we have coverage for basically all things within the 1040. Maybe we'll add more capabilities in the future. When you think about it from a timing standpoint, there was also challenges because the regulatory bodies only allow you to test in very specific times of the year. I don't think people realize this when they look at sort of the timelines and they look at the complexities we have with our tax system. They spend the first half of the year doing the legislation. Then the state authorities, the revenue departments have to convert the legislation into basically tax code because they write law. Now they have to actually kind of roll it out and tell the software providers, this is how the forms are going to work. This is how we're actually going to tax, this kind of case and how we're going to treat it and how to provide a ruling around it. And so that kind of happens in the summer and early fall. And only then do they do testing. And you have to test with the IRS before you can test with the state. So all of that testing, all of our work there basically happens in the late fall and early winter. So it's a very short period of time. And so we were basically running and still run basically a Manhattan style program here where we have to plan all 52 weeks in the year very, very carefully, because if we miss a week, we will potentially miss a window and that will impact our whole business and our clients' business. So we are very regimented and sort of thoughtful in the way that we, map out the compliance side of the house. On the application side, we have a lot more elasticity and flexibility. We're much more rapid in how we react to client needs, but that's sort of more on the pure play software side of the house.
How much time passed between day zero and serving your first customer?
Very short period of time. So I don't believe, even though we were building something that was, I think, very hard to do and took a lot of years, we wanted friction with the market because we said what we're trying to do sort of if we want to get the user benefit. So I think to your earlier question, we had to build the engine, but we also had to build the connectivity layers between the engine and our applications. We had to build our applications and we had to build the APIs and the embedded infrastructure that allowed us to embed inside of the financial apps. And so over time, we were playing with the maturity of those different areas. Now they're all very mature and are at big scale. But it took us a time period to get all those things just right. And some of the early assumptions turned out not to be true about authentication, about the methods that our clients would want to embed, about latency requirements, whatever it was. So there were many different factors that we were constantly reprioritizing and constantly pushing ourselves to be able to get 1 second faster, have another method to serve a client. But for that reason, we had to serve clients from day one. But we didn't have a functioning tax engine. And so what we actually did is we did kind of a sort of an initial beta test where we had the digital skin, but we were sort of doing the work manually behind the scenes. And then we automated it on the engine itself. And then there was this constant debate about what manual work were we willing to do while the automation was being built? How far away could we get, from that process? And so there's these natural tensions you have. And I think as an entrepreneur, those are the things you're kind of getting paid to do. That's the gauntlet that you kind of need to run. And obviously we had our approach based on the field at the time, what competition was doing, what the clients were demanding. But our early KPI, I said this to the board many times, and that's sometimes the entrepreneur. I think the entrepreneur gets to be the contrarian, but then they also have to live with the consequences. And what I told my board and the market and investors was, look, I'm not optimizing for revenue in the early years. It's just not what it's not the thing that I'm worried about. I know if we solve this problem and we prove that we can be the trusted provider that knows how to do this, that has reliable applications, that has the know-how how to generate value for our clients, we're not going to have a problem making money. The problem is proving to ourselves and everybody else that we can actually do those things because, like you said, Walter, this is hard. And so what we spent a lot of time doing in the early years was actually running science experiments. We had a hypothesis, could we get our coding velocity this quick? Could building the app, the tax engine, the way that we wanted to build it, where it wasn't sort of a very rigid, inflexible engine, but was actually highly dynamic and real-time and highly flexible, could we make it performant enough? Could we get conversion to a place where the business model would be viable? And so we had a list of questions, and we were very focused on answering those. And in the beginning, they didn't translate to lots of revenue because of the parts of the market we were focused on, because of the pilots that we had set up with customers. And I think that was sort of a real leap at the end that our investors had to make, which was, okay, guys, we see that you've de-risked the execution, you've de-risked the sort of the market opportunity, but now we need to see the dollars like flowing in. And that's been, I think our business is basically, we continue to grow about 10x 12 months trailing for about 24 months now, and sales roughly double every quarter. And so it has worked out for us. But I think, in the early years, we got a lot of tough questions about, whether we were kind of hanging out in the desert for a little bit too long.
Did your investors understand your the patience required to clear compliance and IRS hurdles, or were they kind of catching up with you?
Many of them did. We incubated the company. Our sort of silent partner, Ronan, is one of the co-founders of eToro International Brokerage, so it's similar to Robinhood. And so he built in the regulatory space. And then many of our investors, besides Teammate, are also from financial services. So we have the QED team, which is a lot of the ex-Capital One team. We have the folks from Nika, which is ex-Visa and Citigroup at the leadership. So they understood that. I think the compounding problem that we had was not only was the technology and the regulatory capture difficult. In the earlier years, a lot of the learning came in very specific times of the year. So you'd work all year to then learn basically everything, in Q1. Now we have a lot of products that are planning oriented, they're data oriented, and so our business is much more diversified than it was. But because we were so focused on just building that very simple application on top of our engine, but in a very particular way, our investors would have to wait like 6 to 9 months to get more data. And I think that part of it was painful for everybody, because that's what everybody wants, right? You want friction with the market and you want data. But we were doing 80% of our sales in Q4 and then 90% of our learning on the application side in Q1. And I think that was very difficult, but also why this business is very hard to replicate, because we had to do that 4 times before we really got to scale. And now we have kind of an escape velocity, but that gauntlet, I think, is one that I would say most entrepreneurs are not signing up for.
I mean, tax prep, it's one of the most tightly regulated industries in the U.S. What were some of the early, can you speak to some of the actual specific regulatory or compliance hurdles you had to overcome, or that merely maybe tripped you up for a while and held you back?
Yeah, there are many different ones, right? So you actually have to get your software approved so that the IRS and the states are signing off on that. That in and of itself is very difficult. It's not just the compliance component of it. It's that they want your software written and sort of delivered in a very specific way, which is arbitrary, right? There's no necessarily rhyme or reason for it other than that's their specification. But meeting that specification, because there are not really example applications out there, is quite hard to do. It's kind of this blind back and forth where you just kind of have to keep going until you get it right and you develop that institutional know-how. So that was hard. We've also spent a lot of time pioneering in the data governance space, because the whole idea of embedded infrastructure is that the data is somewhat portable. And so we spent a lot of time reconciling, CCPA and the data governance rules that sort of most companies are subject to. The IRS has their own rules called 7216. No one had exactly applied that in this format, so we spent a lot of time with lawyers trying to figure out and interpret this, and also getting our clients or prospective clients comfortable with it. So I think that was another area. I think now it's more well understood, but again, the IRS rules don't necessarily spell out every last element of this. And so you are trying to figure out and sort of do the best you can with your teams and based on sort of common sense, just how these things should operate and making sure that you're compliant with the law. which is very important because that's our job, is to help Americans comply with the law. So we are very focused on having a strong compliance program that we can stand behind. I think there's just not exactly a rule book on this. There's, on how to do this. There's a governing body called NACTP, which is the industry's sort of private arm that kind of represents themselves before the IRS and the states, and sort of they work together as a team. So we have a couple of our team members actually sit on the board of that organization, which does help. We do have a line in now that others may not have. Although we do work on behalf of the whole industry, so you can apply to join that, and we will also work on behalf of everybody to try to have better software and a better experience for all Americans. I think there's more than enough room in the marketplace for than just us, and there are others just working with clients through their issues, because we have clients that are in wealth management, that are in banking, payments, and all of them are subject to their own regulatory regimes that they're then trying to reconcile with us. And so that constantly presents new challenges. And again, I think as part of the moat and the business know-how is how do you navigate those and end up with with compliance frameworks that are compliant and also functional so that everyone can achieve their goals.
I'm kind of curious, how did you decide to go to the embedded, like the white label route, instead of actually spinning out your own kind of customer facing company? Well, how did you validate that strategy before you actually started building it?
Yeah, so I forget if it was Mark Andreessen or somebody else that said, great entrepreneurs can reorganize the world around themselves. I'm not sure if I'm a great entrepreneur. I'll leave that to the critics to figure out. But I think this notion of developing a strong thesis about what the future looks like and how you can build and reorganize the world around it is an incredibly important superpower. It's not how every great company is built, right? I think great companies are built through just pure raw iteration with the market, and they just constantly iterate on the data, and then they find something and it explodes. I think, I have a different way of working, which is a little bit more thematically, where's the world going and how can I be a part of it? And I looked at financial institutions in the United States, and I said a couple of things. First of all, they're all commoditized. There's really very little that one of them can do that somebody else can't do, and the cycle times are happening faster. And now you have financial infrastructure that's allowing anybody to go do that, right? You have BaaS infrastructure, payments infrastructure. So the moats are just deteriorating. And then the physical moats are deteriorating. So it used to be that like JP Morgan and Chase were in one area of the country, Wells was here, you had the regional banks and the community banks. But now you can go online and get the best, you can mix and match. And so I said, well, that's kind of interesting. So basically the moats are going away. And the software capabilities are going like this. And I think that the opportunity is that in a world where basically all the services are the same, then I think you actually have consumers and businesses that are very hungry for specialized services. And I think that is the real opportunity that we saw 4 or 5 years ago as the picks and shovels providers to the financial industry is all of these players are going to have to find ways at scale to specialize. They're going to need to deliver personalized services where they actually understand who you are. They can deliver a customized, high-touch solution. It could be digital only, like a Chime. It could be a combination of people and digital, where they serve the person at the right time, maybe like a Chase branch or something like that. Or it could be a human touch, but where the human has a lot of leverage based on the technology they have in the background. I don't think it necessarily really matters. I think we're going to see multiple solutions across the market, and we're playing in all those markets. But to do that, they need 2 things that they didn't have today. Number one, they need data, because they actually don't have the data in a highly available format. It's kind of scattered. They have pieces of it. They have, maybe some transaction data, maybe some statements about your wealth, or they don't really understand who you are. The tax dialogue actually provides a way for the individual who's already spending 10 to 15 hours to just tell their preferred provider about this directly without having to do additional work. We always joke that, tax returns is kind of like going to the doctor but not getting the result, right? You're kind of spending the time aggregating everything, but you don't find out what happened. And on the other side, they need the permission to have the discussion, because you might have an institution that's had a 10-year relationship with someone just around checking accounts, or someone else that's only talking to them about their retirement. How do you bridge that gap to say, I actually have more to offer you. And that's the problem a lot of our clients have, is they have the product SKUs and they're trying to understand why they're still reacquiring and paying to reacquire the same client. And it's because the client's not used to thinking of their brand in this holistic way, because we spent 10 years training everybody that they were just going to have all the different apps on their phone and they were going to have one app for payments and one app for credit cards and one app for banking. But that's totally unsustainable. It's unsustainable from a cost structure standpoint, but it's also, I think, not the way that's going to lead to the best financial results for most Americans and businesses. They need consolidation to actually get the advice and service that they need at the price that they can afford to pay. And so I think what we saw was really that tax was an immense opportunity to help facilitate that future. And we didn't know exactly how. And so that's kind of why we started with the engine and the infrastructure and spent time building friction with the market to develop very specific theses. And now we understand when we go into banking or wealth management, we have a very, very specific pitch and a very specific sort of capability that we've built, which are very different for those markets. And so that's also something that we've kind of defined and developed over time. Same for small business and so on.
I mean, you came into this with a very strong network and a pretty bold thesis. What did your customer discovery process look like? How many people did you talk to before you started actually?
I think before we even started the company, we probably spoke to like 100 financial institutions. So it was, and then since then, we did, I don't know, 12 pilots. Then we had 20 paying customers. Then we had 40. I don't know the exact number. We're in the many dozens today, and that's been through a series of now probably thousands of conversations. Some of which, by the way, were with the same institutions, finding the right person, finding the right pitch, or the right sort of concerns to overcome. So we've had to sort of thread many different needles. But I think for us, what's been interesting is sort of as an infrastructure, as a B2B infrastructure provider, lining up that B2B to C, of lining up what is our customer trying to solve for and who is their customer. And I think that's something that took us a bit more time and maybe we underappreciated in the beginning. It's like, oh, the customer of our banking clients that serve moderate income Americans, the application needs to be served up and priced and constructed in this manner. Our clients that serve mass affluent Americans through a wealth management channel, it actually looks totally different. And I think that discovery process is one that I think we were sort of more naive actually looking back on it than I would have liked in the earlier days, and something, through many discussions and iterations, I think we're now quite close to perfecting.
So I guess we're almost into October. In July, I think you raised a 38 million Series B after growing revenue 8x in 12 months. Pretty good.
Yeah.
Backing up, what did you have to prove at seed and Series A, respectively?
Yeah, I mean, I think that the answer, I have a lot of these discussions with entrepreneurs, and I think it's the thing that I find most striking about our business is that, at least in theory, the successes were always the outliers. So by default, they were doing things that didn't quite make sense to the rest of the market. And we spent so much time as an industry, as a venture capital industry, trying to get everybody to conform to sort of like a set of benchmarks. And so I think that these indicators are benchmarks, and they're helpful to understand, where should you be in theory relative to your peers? How is pricing being used, right? Like, what's the going rate for 5 million ARR in this fintech company versus that, consumer company? It's useful to understand where you are, but at the end of the day, many of the best opportunities are not going to fit those molds exactly. And so seed rounds, sometimes if you have a repeat founder, they get funded with no deck and no company. Someone just says,
a handshake. Yeah.
How much money do you want? And let's agree on a price, and that's it. If you're a first-time founder, maybe from a very impressive background, maybe you went to a great university or you came from a very specific team. Someone might want to see the pitch and they might want to understand the plans. Maybe they want to see a POC or some customer discovery calls, right, to do a seed. And if if you don't have that luck or you don't have that network, you might have to show a little bit more, maybe actually get those first few customers, or some kind of working product out the market after you get a friends and family round done. And I think, as you move up, that goal line is constantly shifting. It was 1 million Then it went down to 500,000, and then it went up. The market got really strict. People wanted to see 2 or 3 million. I never really looked that much at those. I don't think that those questions are that interesting because at the end of the day, in venture capital world, okay, you're working backwards from a huge opportunity. So to me, it's what did you learn at a 500,000 or 1 million or 2 million that you didn't know at those different numbers, and what have you proved to yourself and investors to be able to attract more capital? So I actually, to be honest, and I've written a little bit about this on LinkedIn, like I actually use that as a way to filter out venture capitalists because I think when they ask those questions, they kind of show their cards that they're actually not that sophisticated. And I get it, in venture capital is institutionalized, and so now you have different people at those firms that have different criteria, specialties, or just like they're trying to filter their own time. But that's our job, is not to be market takers, but be market makers and find find the people that are going to help us propel our business forward. So I kind of refer most of my colleagues or peers back to that same like rubric of like, what is it that you are working on? What is the big opportunity? What is this set of capital going to get you to? How are you demonstrating that you are moving along that curve and de-risking it and increasing the size of the opportunity and gaining execution momentum? And then just trust that the capital will be there. And also don't overprice your company because that will hamstrung you. And that's where these problems arise, is you have companies that raised a seed round at $100 million. Well, now the bar for what they have to do at the A round just naturally became a lot higher. So,
Right.
I think there are those benchmarks. They kind of move around a little bit, and by talking to investors and others in the market, you can kind of get a sense of what the market wants to see. But I think that the most important thing is really understanding that venture capital is trying to do two things. A, it's trying to fund growth, and B, it's trying to fund big outcomes. And you need to constantly be asking yourselves, how is what you're doing putting you on a path for those things?
How big was the team at Series A, and how big is it today?
Um, so at Series A, we had raised a seed kind of in the back half of 21, and then we did the A pretty quickly thereafter. So
Okay,
our
so
A didn't,
at seed then, at seed.
yeah. So we were about probably 5 people at seed, and then maybe by the time we did the A, we were maybe 25, 30. And we actually stayed at about 50 people for about 2 years because a lot of our team was just working on the infrastructure, and we had a pretty lean go-to-market team. So really, only in the last, I'd say, 3 or 4 quarters have we really started to reaccelerate on the headcount growth. I think we also have been the beneficiary of a lot of efficiencies. We see our engineers today are more efficient. Some of our sales and marketing efforts are more efficient through the use of AI. So we are seeing some leverage there, but now we're really seeing the reacceleration of headcount growth behind revenue growth, which is great versus the earlier days. It was really more around, okay, we want to go build this thing. How many people do we need to build this thing and keep the lights on,
Mhm.
and also get friction with the market? So, we sort of got to some critical mass and then sort of stayed flat for a little while, and now we're back on that growth curve from a headcount standpoint.
I mean, do you still interview every new employee, or have you kind of let that go?
I don't, for a couple of reasons. Again, I think this is one of those things where founders need to find the things that work for them. I like to build systems. So we've had an HR team that's been very good at instilling our culture. I think they do a better job of interviewing the candidates than I do for some of those things. And I spend a lot of my time making sure that we are actually operationalizing the things that we care about here. And so it's actually more often than not, our own team will be even more protective than I am about making sure we're finding people that are going to come in. And we do make sure there's kind of three, I'd say, executives at the company. We have a president and COO, my co-founder, and myself. So the rule is right now that one of us has to interview everybody. For an executive, it's all of us. So it's, well, but just for hiring to be faster, and also because we want to have the person that's best suited to understand that role, at the forefront. I don't believe in sort of democracy, if you will. And so I'm not trying to get to consensus. I'm not trying to see like if my HR team and my president and a salesperson all like another salesperson, like I don't know that there's like an incremental use of my time to do that. And why should we slow down the process till it gets on my calendar? I just don't think it's not a good use of time at the margin.
Yeah. What's been the most important, I guess, founder behavior or strategy shift, uh, scaling between day zero and Series B?
I think it's that shift from you're doing everything to the delegation phase and figuring out what are the tough problems or the things that you can't delegate today, but making sure you are delegating, right? If you're scaling and growing to crazy scale and you're still the one doing all the stuff yourself, like that's going to break. On the other hand, you don't want to give up total control, at least over the quality. You still want to have checks in place to make sure that things are sort of where you have a quality of team, you have a quality of product. And then there are some things that there is nobody else to give them to at the moment. And so I think it's finding that balance, and you just, at least I found I constantly have to reinvent that because and so I think, and that's where second and third time founders will build better muscle memory there. They just kind of have that intuition. I think mine is improving over time. Maybe not still perfect, but constantly trying to refine sort of like where I should be on the spectrum at any one of these on what am I doing directly, what am I delegating, how am I maintaining quality. And then I think the other one is you just have to build a ton of resilience. I don't think that necessarily gets any easier. I think sometimes it's maybe not quite as existential in the early days, but in this business, even if it's not existential, if you don't grow, it becomes existential. So it's effectively existential. And I think the resiliency and finding ways, to have a good family life, a good, social life are also important. I think this is a game that it's so intense that if you have that 100%, you need some kind of outlet. And so I think finding ways to, maintain mental, physical health, happiness are not only good things to do, but also make me a better entrepreneur and a better CEO.
I can't really tell whether they're successful operators, but I see a lot of operators chasing clout on LinkedIn, encouraging people to kind of forget about work-life balance and embrace the 996 lifestyle and grind culture. And it doesn't seem sustainable to me, but I see a lot of people who seem to be flexing on it. I kind of wonder what you think about that.
Yeah, I mean, I'm a big kind of work smarter, not harder kind of person. But early in my career, I did do that. I was working more than 996. I was probably working 912/6. I was working, for some pretty important people and, meeting with Fortune 500 CEOs and heads of state. And yeah, I mean, and I learned a lot. But also as I've gotten older and matured in my career, I have a lot more leverage. The thing that used to take me 2 hours now takes me 5 minutes. And instead of having to network six people over to get something done, I can send a text message and do it. And I'm also able to do some of my work in a way that doesn't require me to necessarily be in front of a computer. I can go on a walk and take a phone call. I'm still being healthy. I'm moving. I'm getting sunlight, but I'm also having an important conversation. So, and I believe in forcing functions, right? Like having a very regimented schedule forces you to actually focus on the things that are important and going to, and I think if you look at any great leader, whether it's Bezos or Peter Thiel, guys that have, I think we can all agree, like are at the top of the field. All of them sort of have this in different flavors, like intensity of focus on a couple of things. And so if you're really intensely focused on staying up for 4 nights in a row because you have some bottleneck in your product, that's going to happen at points in time. It just does. It happens here. But if you're doing that like 365 days a year, 52 weeks out of the year, you're probably not working on the right things. You're probably not working as productively as you could because you're tired, your diet's off, your sleep's off, so that you're not getting as much bang for your buck. And so, yeah, I don't know. I think it's okay. And also maybe more junior teams, like there may be a point in your career where you need to work that way. But I think I strive for like, when I'm working, I'm leaving it all out on the field. We're doing this podcast right now. You have my full attention. I'm giving it everything it has when I go to my next meeting. But I'm also, at least 80% of the time going to get a full 7, 8 hours of sleep.
Got it. For early first-time founders, what are some of the biggest mistakes fintech founders you see them making these days?
I think the biggest mistake that I see people, because there's a lot of really smart people out there, and even though they maybe don't have the work experience that you'd expect, I think still if you look at the distribution curves, I think it still favors slightly older founders in terms of just having the career experience, the network, which makes sense. I think especially in this age of AI where things are changing so rapidly and the old ways of doing things, are being challenged, it reminds me a lot of the early 2000s. I think there is opportunity out there for either younger or just first time founders for sure. Also, especially ones that can come with some insight about technology or industry that someone else may not have. The conversations that I have most often are just sort of an obsession of focusing on the wrong thing. Like they're just, and when I say wrong thing, it's not even about the business. Like forget like, there's like these tweets going around, first time founders focus on products, second ones focus on distribution. It's not, I'm not even like at that level. They're like spending hours going back and forth on some document with their investor, or they're spending, lots of time negotiating over some agreement with somebody. And part of it is because they may not have the framework and the gravitas to do that negotiation more efficiently. But I think also contextually, they just realize that like, if you want to build a startup, a high growth, high velocity startup, you need the best talent. Like negotiating with that person over another $5,000 or,
right. Not the best use of your time. Yeah.
It's just not the best. So you try to focus on what are the structural things in that agreement with that person I need to set up. And then it's kind of like, let's get this. I need to focus on getting this done in the next 48 hours, not sort of belaboring 2 months of like back and forth. And I think those traps in different ways are just ones where I find sort of first timers or earlier stage founders just sometimes getting weighted down in the process.
My final question for you. If you're interviewing for a job at an early stage startup, what's one question the CEO would have to answer before you could take the offer?
I think the thing for me is I just want to understand the decision making, because if you're excited about the vision and you're excited about the team, those are things I think that are kind of like obvious. I think the thing for me is you want to be at a place that's going to move fast and be decisive, because that's where a lot of these companies get. And so I get stuck. I think I would try to spend time understanding the founder CEO's decision making process and how they make decisions. How comfortable they are being uncomfortable. And that to me would be a very good sign of whether or not I would want to join a company or not.
Ben, thanks so much for a great time today. I appreciate the conversation.
Thanks for having me, Walter. This was great.
The Fund Build Scale theme was written by Michael Tritter and performed by Michael and Carlos Chairez. Michael also composed Ocean, the track you heard at the top. If you enjoyed the episode, please subscribe and leave a rating. It helps more people find the show. You can get the Fund Build Scale newsletter on Beehive, follow along on Instagram, and if you have a guest suggestion or a question, reach me at fundbuildscale@gmail.com. Thanks for listening. Fund Build Scale is a production of Truth and Soul Media, LLC.